Thanks to the internet, many investors are teaching themselves about investment products and strategies. But, and this probably isn't news to you, there is always a chance that some of these things we see or hear on the internet aren't true. And when it comes to options, it's no different. So let's look at some of these common misconceptions. Starting with this one. All options strategies carry the same amount of risk. It is true that there are risks associated with trading options, but there's usually risk of some kind involved with any financial instrument. Because option strategies can be more complex than other investment types, they can carry relatively more inherent risk depending on how they're used. The truth is, though, that once a trader or investor fully understands options, they can use different strategies to help control their portfolio's risk. 2. Options are only used for speculation. Speculation is just one reason to use options. They can also be used to try and generate income, hedge against other investments, or establish entry and exit points for equity positions. 3. Options are only available in margin accounts. Believe it or not, option trades are allowed in both margin and registered accounts, like TFSAs, RRSPs, and RESPs. That said, margin accounts do offer more flexibility when it comes to which strategies traders can employ. But this also comes with additional risks, so keep that in mind if you're looking to trade with a margin account. 4. Options expire worthless, so they're a bad investment. True, options can expire worthless, but it is possible to make a profit with an option trade without exercising it or waiting until expiration day. For example, by selling the option in advance of expiration. Plus, it's sometimes cheaper to purchase options on a stock than to buy those shares outright. In cases where the stock declines, the trader will be out less money letting their option expire than they would have been if they had purchased the shares outright. 5. Puts are riskier than calls. Calls, puts, it doesn't matter. The pricing models are the exact same. They're largely based on the potential and actual movement of the underlying stock. One thing that might contribute to this misconception is the reality that stock price movements downward can be more sudden than price movements upward. 6. You need a big portfolio to trade options. Yes, some strategies have minimum equity requirements, but they can be relatively small compared to the capital required to own 100 shares of some stocks. One of the main benefits to trading with options is the leverage they can provide, which makes them more accessible to portfolios of any size. 7. Trading options is an easy way to make money. The probability of a stock rising in price is the same whether you own 100 shares or just one call option. A more accurate statement is that option strategies may provide investors the potential to make a profit in various market conditions. And 8. A $1 move in a stock means my call options go up by $1 or my put options go down by $1. This is one of the biggest misunderstandings in options trading. An option is assigned a value called delta. The delta of an option has no bearing on the price of the option itself. Instead, it represents how much you can expect the price of the option to change given a $1 increase in the price of the underlying security. The delta is usually expressed as a decimal, either positive for calls or negative for puts. For example, the $70 strike in this call chain has a delta of 0.96. This means if the price of the stock goes up by $1, the option value should go up by roughly 96 cents. And once again, the opposite is true for puts. The $70 put has a delta of negative 0.04. This means that if the price of the stock goes up by $1, the option value should go down by roughly 4 cents. If we look at an option chain, you'll see that options that are in the money have a higher delta value than options that are out of the money. Also, the further in the money an option is, the higher its absolute delta. We'll discuss how delta is determined in a later lesson. But for now, just know that the days left until the expiration of the option and the stock's volatility are factors. There you have it. This list is by no means comprehensive, but it highlights some of the more common misconceptions you may come across online when looking into options.